The third quarter of 2023 was a weak period for most markets. This came mainly as market participants realized that central bank interest rates would likely have to remain high for longer than previously expected. A sharp rise in oil prices as Russia and Saudi Arabia extended their production cuts caused the inflation outlook to deteriorate as well. A growing focus on persistent US budget deficits, as well as a US credit downgrade by Fitch, put further upward pressure on real interest rates. This provided the backdrop for weaker equity as well as bond prices, which is unfortunately not an ideal environment for multi-asset portfolios. Developed market equities and bonds both fell across the quarter. The US dollar strengthened against most major currencies, gaining more than 3% in Q3. This was supported by the rise in real yields, which have now reached their highest level since the financial crisis. It's remarkable to us that the real yields offered by US government bonds have moved from record lows to multi-year highs in the space of less than 2 years. In South Africa, the key story of 2023 so far has been ailing infrastructure from the electricity and logistics systems and its consequent drag on sentiment. But thankfully, some green shoots are beginning to emerge from what is unfortunately a very low base. The Fed raised interest rates again in July. This then took borrowing costs back to levels we last saw all the way back in 2007. Higher interest rates, though, are visibly succeeding in their aim to cool high inflation, which has allowed the Fed to pause its hiking cycle in September, and the market's now only pricing in a 50% chance of any further interest rate hikes in this cycle. In general, the sharpest contraction in money supply in 60 years is having a smaller impact than we might have expected. Yes, non-performing and delinquent loans are visibly on the rise, but there are few signs of real stress in that American economy just yet. Short-term data suggests that central banks might just manage to cool inflation to their target of around 2% without causing a recession or a material increase in unemployment, but we're not sure yet, and certainly high oil prices aren't helping. The signal certainly from the bond markets points towards an economic slowdown in developed markets in 2024. Among the factors delaying the transmission of monetary policy to the general economy is that most United States home loans actually have fixed interest rates nowadays, so consumers are not being squeezed as much as they would have been in prior hiking cycles. Despite losing some ground over the quarter, equity markets are still pricing in a good chance of the so-called soft landing. Long-term inflation expectations in developed markets do remain well anchored, and their labor markets are definitely more flexible than in the past, with lower union membership as well. All of these factors combine to help reduce the stickiness of inflation. So while our base case scenario remains a mild recession arriving in early 2024, either way, as always, our focus is on constructing portfolios for our clients that are robust to a variety of outcomes. In terms of asset class performance, most assets were down in nominal terms over the third quarter, with cash really the best place to hide. Equities struggled with the MSCI World and S&P 500 indices falling 3.5% and 3.3% respectively over the quarter. Euro stocks struggled, that fell almost 8% in US dollar terms. The MSCI Emerging Markets Index did a little bit better than global averages, but still lost almost 3% through that third quarter. From a style perspective, there wasn't too much in it, but value stocks did perform best, falling less than 2%. Growth stocks gave back some of their first half gains to be down 5% over the quarter, although they are still the best performers year to date, up almost 21%. Global equity markets remained quite narrow, with much of the S&P 500's returns driven by only 7 stocks. From a sector perspective, the more rate-sensitive areas like consumer staples, technology, listed property, they suffered more from the focus on bond yields, and all of those sectors were down more than 6%. By contrast, energy benefited from the higher oil price, so energy stocks up about 12% over the quarter. Global bonds continued to struggle through the quarter. They lost 3.6% to be down more than 2% so far this year. And in general, bond markets are grappling with the combination of bond issuance, which is increasing due to higher budget deficits at a time when price-agnostic buying by central banks is being scaled back. So as in, there's no more quantitative easing, there's quantitative tightening. But in our view, it makes little sense that the US is running such a high budget deficit at a time when the underlying economy actually remains in quite good health. Through the third quarter, commodity prices traded higher, but the performance was mixed between the different commodities. Brent crude oil, obviously the star there, unfortunately for the rest of us. Oil rose 28% to end the quarter to over $96 a barrel, as OPEC production cuts weighed on supply. By contrast, gold fell almost 4%. When we look at South Africa, the rand's volatility continued. Our currency fluctuated between 17 Rand 50 and 19 Rand 50 to the dollar and ended the quarter at about 18 Rand 92. Our local equity market lagged its emerging market peers, down about 4% for the quarter in dollar terms. The numbers do look a little bit better when expressed in rands. The Aussie was up about 2% in our local currency. Within our market, industrials performed best, while resources lagged in line with lower platinum prices. Our local bond market gained about 1.5% through the quarter, and cash delivered 2%. The Houseview equity model's performance so far in 2023 is pleasing in relative terms, where we managed to beat our benchmark by 1.3 percentage points to deliver 3.5% return, which unfortunately is quite low in nominal terms. Over the past 12 months, however, this portfolio returned 17.5% after fees and 17% per year over the last 3 years. So that's about 2% per year ahead of the benchmark and about more than 3.5% per year ahead of our average peer. So far in 2023, our overweight positions in Bidvest and Standard Bank have delivered for us, as did our underweight to the platinum sector, but not owning Sanlam shares acted as a bit of a drag on performance. The portfolio is in the top quartile of its peer group over 1, 2, 3, 5, and 10 years, which leaves us quite comfortable. Our worldwide equity portfolio has had a slightly tougher time of it so far in 2023, given the narrow global market that I spoke about earlier. Although this portfolio delivered a return of over 19% for the 12 months to September, and just over 8% for the year to date, this is behind its benchmark. While this portfolio does have quite a lot of exposure to some growth businesses like Google and Microsoft, in general, its positioning is more tilted towards defensive names in the healthcare sector. We expect that should serve the portfolio well in the coming months if broad economic activity slows as we expect. If we then move across to our Regulation 28 multi-asset portfolios, the performance here is certainly pleasing. The balanced, moderate, and conservative balanced portfolios are all ahead of their benchmarks over 1, 2, 5, and 10 years after fees, and they're in the top quartile of their respective peer groups over most of those periods. These portfolios benefited from both the SA equity component doing well, as well as positive asset allocation calls. While we had a relatively quiet quarter in terms of activity in the equity portfolio, where the only meaningful change was to increase our Anglo Gold holding, we were certainly more active in the balanced mandates. In July, we added some hedge fund exposure to those portfolios. We're quite excited because we expect the uncorrelated nature of these returns to improve the reward versus risk trade-off within these portfolios. And we think that's particularly useful in the current environment where we are a bit worried about the macro. Overall, our positioning across our portfolios remains relatively conservative, as in previous videos, given our concerns over the impact that the material tightening in global financial conditions over the last 15 months is likely to have on future economic growth. We maintain our view from earlier in the year that we're unlikely to see any reduction in interest rates in 2023, and we may even see one more hike. When we look at global equities, despite the recent correction, prices are still higher than average on a forward price to earnings multiple basis. So they're looking a little bit expensive. And in addition to that, we are still concerned about a seeming disconnect between consensus earnings estimates for the US market, which are marginally up so far this year, and the way that various leading economic indicators are flashing red, pointing towards maybe a tougher time for markets. The VIX, which is a gauge of volatility, and that effectively serves as an indication of the overall market's level of fear, has only recently begun to rise off its low level. So the market's getting a little bit more scared, We think, unfortunately, it can get a bit more scared from here. This does suggest to us the US market was a little complacent and is only now starting to factor in a more concerning broader economic environment. The market also appears to be realizing that although AI may have a huge impact on society, this will likely take some years before we see proper impact on company profits. If we then shift our attention to South Africa, we, in our market, have a bit of a different situation. Our market looks quite cheap relative to both its own history and relative to global peers. The focus within the quarter shifted away from load shedding, more towards commodity prices, particularly the platinum group metals. And the concern for the broader South African economy is that lower metal prices mean miners will likely pay far less tax for 2023 than in 2022. As we look ahead to the final quarter of the year, we note that signs of the impact of higher interest rates on the economy are beginning to appear, and we suspect that the coming months will show more of the pain associated with this tighter monetary policy. We do expect to see further signs of economic deceleration in the world. We do remind clients that we've been preparing for this outcome through the course of 2023 by tilting our portfolios to make them more robust to a recessionary environment. This is through both our more defensive equity selection as well as our asset allocation, which is tilted towards bonds a bit more and away from equities. Global equity valuation and earnings expectations remain above trend, while offering quite a low, in fact, a very low risk premium over bonds. By being more circumspect now, we're hoarding so-called dry powder to enable us in future to deploy more money into risky assets at a time when maybe prices become more attractive in future. So in conclusion, we don't believe that the economic cycle has played itself through yet. We expect the global investment clock to progress to a recessionary phase over the next year or so. The market appears to be starting to realize this, but has some way to go in our view, and hence the positioning within our client portfolios remains relatively conservative.